Alright guys, welcome to the first lesson of my course, and we're going to be talking about the very basics of trading. So if you know anything about trading, don't watch this video, skip to the next one, because we're going to be talking about candlesticks, trends, and yeah, and how the markets move. So basic stuff. Alright, okay, first, candlesticks. What are candlesticks? These are candlesticks, right? These little things here are candlesticks. By the way, if you guys open up TradingView, that's what people use to trade or like look at the markets. It's not gonna look like this, all right? It's gonna look like green and red. I just have the settings set differently. Hold on, let me show you guys how it should look like. All right, let's open up NQ. It should look like this. Okay, it shouldn't look anything like mine, or at least the color difference. Right. All right, candlesticks. What are candlesticks? These are candlesticks. There's two parts containing of in a candlestick. So there's hold on. There's two types of candlesticks, right? There's downwards closing candlesticks and upward closing candlesticks. So basically, red candlesticks and green candlesticks. So there's two parts. There's the wick, which is this line here, and this line here, and the body, which is this part here. Like, what the hell is wrong with my? All right, this part is the body, and this part is the wick. All right, pretty simple. So what are wicks? Let me get rid of this one. Wicks are basically where the price was before it closed. So as you can see on this candle, this is a downward closing candle. So downward closing candles opens at the body high and then closes at the body low. So this, and it's the exact same opposite for upwards closing candles. So it opens at the bottom of the body and closes at the top. So what wicks are basically where price was before it closed. So this is downwards closing candle. So price opened here and then went up at one point, and then it was down here at one point, but finally decided to close right here. Same thing, same exact opposite as if it was a green closing candle or like a upwards closing candle. So price opens right here. It was down here. It was down here at this wick at one point, and then it was up here at one point and finally closed right here. Okay, pretty basic, right? I mean, like, that's all you gotta know about candlesticks. All right, so now we're gonna be talking about trends and how the market moves, right? There's three ways the market can move: either downwards, which is called bearish, and upwards, which is called bullish. Okay, bear and bull, pretty simple. Okay, so how do trends work? Trends create lower lows, something called lower lows, higher highs, lower lows, higher highs, lower lows, higher highs. Okay, when it's moving upwards, when it's bullish, it creates higher lows and higher highs. So it starts off with this low right here, and then goes up and it creates a new high. So this is called a higher high, and then it goes down and it creates a low, but it's not below this low right here. So it starts here. A higher low is a low that is created, but it is not below, it is above the previous low. So low and then another low that is higher than this low. Pretty simple. And then higher high is when the market creates a new high that is higher than the previous high. So here's a high right here. It creates a higher high, higher low, and then goes up. It breaks this level, it closes, and then creates a higher high, which is higher than the previous high. Pretty simple stuff. If you can't get it, you're an idiot, right? So boom, lower low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher low. Okay, you should get it at this point. It's the same exact thing if it's bearish when it's going downwards. So we got a higher low, and then a higher and lower high, and then a lower low, lower high, lower low, lower high, lower low, lower high, lower low. All right, same exact thing. A higher high right here, and then it creates a new high, but it is below the previous high, and then a new high below the previous high, a new low above the previous high, right? And then a low, and then a lower low, which is below the previous low, and then lower low, lower low, lower low. Pretty simple. Below the previous low. So this is the previous low, and this is a lower low. It is lower than the previous low. And then a higher low is a low that's created, and that is higher than the previous low. So boom, right here, lower low, and then there's a new low here that is a higher low. It is higher than the previous low. Same thing as if it was higher highs and higher lows, right? There's a higher high, which is above the previous high. This is the previous high, and this is the new high, right? Higher, lower high, and a higher high. It is above the previous high. And then a lower high is basically the exact opposite, I meant. So it is below the previous high. Higher high, lower high. So if we spot this in the market and you get good at it, you shouldn't even think about it. So yeah, if you look at this is a lower low, higher high, and then a higher low, and then a higher high, and then a higher low, higher high, higher low, higher high, right? And then downtrend. Okay, that's fine. Alright, you can see this point right here is a higher high, which because it is higher than the previous high. So higher high, and then a higher low because it's higher than the previous low, and then a lower high, and then a lower low because it's below this low.